What's going on, man?
That is all I have to say is from our last live stream. Here we are. I mean, a lot of you probably heard it from us first, right? Like, this is where we're heading. And I think we're just beginning to get on this roller coaster ride, if you will, in the stock market. What do you think?
Yields are telling you one thing, the market is saying something else. Short term, I think we're going to have a decent run here. I think we're going to see a big separation between companies that are hitting earnings and companies that are missing earnings. It's going to be a very confusing story, I think, when earnings start coming off here. I think we're going to see some banks absolutely kill it and some banks really disappoint. And we're going to question a lot of things. And I just think we're going to see a big separation in different things here because I think companies are dealing with different type of problems here.
Touché.
Oh, absolutely. I mean, just today, if you're looking at, their earnings coming in from Delta, they were expected to bring in 1.1 billion, and they came in much lower than that, coming in at around less than 750 million.
Wow.
That's due largely to labor, right? And then also oil.
The fuel
I think
costs.
oil was up for them by like 35%.
And
Cost.
they still said demand was extremely high, which I find pretty interesting here. I mean, for us, I think it's kind of we're on the cusp of are we heading into recession? To me, the signals are that we, I mean, you already know how I feel about this, that we are, and we're just going to get confirmation down the road here in the near future.
We are in a technical recession. I mean, look, we looked at the inverted yield curves twice now, from the last live stream to the one prior. We've been talking about the yield curves, but when we dive into historical data published by the Fed out of San Francisco, they have shared with us that, I mean, it's a very accurate indicator. When the yield curve inverts, since 1955, it has been an accurate indicator that a recession is well on the way within 6 to 24 months.
Right.
I believe, like I said, we are just really getting started. At the end of the day, I mean, we are going to go towards a 75 basis point rate hike.
Oh, absolutely.
I think it's just going to get much more red in terms of the stock market. There's going to be a lot of fear.
This is the worst.
And I think we're already starting to see that, right? The market today is bouncing quite a bit. We just have impulsive investors out there. At the end of the day, I think we're dealing with a matter of impatience when it comes to investors. We're not willing to wait for the data. We get a tidbit of positive news, and all of a sudden we bounce, and then we fall. So I think we're going to Colton's point, we have more earnings coming out. Earnings season is just underway.
Yeah.
So take that in consideration. And then at the end of the month, a whole heap of fear is going to come our way. Even though we know Powell's coming out with the rate hikes, it is going to shock the market.
We made a great effort so far. Let's just keep it up.
That's right. We can't have anyone freak out there, okay? We've got to keep our composure. We've got too far. There's too much to lose. We've got to keep our composure.
I would agree. I mean, I think earnings are going to tell a pretty interesting story here, and it's the forward guidance that I'm more interested in. But it's just like, you hear so many different things. Somebody messaged me that, everywhere they go, it's busy and the jobs are popping. And then you look at companies like Meta laying people off, companies like Tesla laying people off, and it's just like Oracle laying people off. I mean, it's layoffs left and right. And that's where I think business models are getting hit differently. And it's gonna catch people off guard. I think the next company that falls. I mean, Revlon, filing bankruptcy. Gap, dude, the Gap is in trouble.
Gap CEO step down.
The Gap is in trouble. They got a ton of debt. They have no margins. I mean, they're in trouble.
They've been falling for quite some time. Look, Google, I think yesterday, if I'm not mistaken, yesterday evening maybe, and there was a company-wide email from the CEO essentially stating that Google employees better step it up or else they're going to get the boot. And what that tells me is Google's under pressure. All the tech companies are under pressure. Of course, different industries are hit differently, but in terms of where we're at right now, it's not looking good across the board. And I don't really see a reason why the market's are green at any
To
point.
me, I think they're seeing through the inflation story, and they realize because commodities are coming down, oil prices are coming down, it's clear that we've hit the peak. This is probably as bad as it's going to get, and I think the market saw through that.
I agree with your remarks, and commodities are coming down. Gas is coming down, but at the end of the day, I actually think it's almost a self-fulfilling prophecy as well that's in the works for us, because I think when the market is spooked, we talked about this last live stream as well. We're totally emotional creatures. Yeah. And I think with the fear mongering that's out there, we're also getting a lot of that working into investor sentiment right now. And is it a good time to buy? Is it not a good time? But also take in consideration, last month we shared, right? And I think this was the sentiment across the board that was being shared. Inflation has peaked.
Yeah.
And it certainly has not, right? I mean, just if you haven't heard the news, get your head in the news. But inflation was expected to come in at 8.8%, and we are now at 9.1%. We've been sharing for weeks and weeks now across the board, right, that inflation must have peaked. It must have peaked. It hasn't. So I don't really 100% want to put my money on, this is it.
Yeah, I think it's too early to tell, because you just never know what the next thing that could come. All of a sudden China's stirring the pot of something, and it's a whole nother story we're dealing with. So as far as that goes, the political tension seems pretty high right now, and almost anything is possible. A missile could get directed the wrong way in the Russia-Ukraine war, and all of a sudden it's a world war. There's just too many things right now, too many uncertainties. You factor in the fact that the Fed still have to raise 75 basis points again. We both think that's coming. They're still unwinding the balance sheet. Ari, we don't know what the first hike is going to feel like yet. We have yet to feel that. Like, it just happened. It takes 6 to 10 months for this stuff to get through the system. So that's why I think, they're going to over tighten into a slowing economy, because we're obviously slowing. And at that point in time, it's going to be too late. But the repercussions we're going to feel are probably not going to be until January, February, which when that does happen, they're going to say, yeah, we think recession happened right around end of June of 2022. That's what I think is going to happen.
Oh, it's our Monday morning quarterbacking, right?
That's right. Yeah. That's what we do.
There we are, right? Here's what we should have done. This is what went wrong. And I think that happens all too much. And I think we're looking at that right now, right? Because now everybody's looking, we're saying, Fed Chair Powell acted too slowly. He didn't react quick enough. But this is all in hindsight. And I think you might be right. I mean, this may be very well a case where now we're just looking back in hindsight and, we overshot the mark, and now here we are. But again, this is what makes economics so comical, is that you look at these macro viewpoints and now you get all the Monday morning quarterbacks coming out.
So let's talk about how we can help investors that might be confused right now, right? So I heard an interesting statistic that's going to just fall into your wheelhouse. So stock performances over the last 100 years, the stock gains that have happened over the last 100 years, 50% has been made up of dividends.
Proof's in the pudding.
Boom, bam, bop, bada bop, boom, pow.
So if you're in a stagflation environment, and growth is none, I think what we're seeing with the yields is growth is limited to none, possibly negative growth over the, we could have negative 4 quarters of negative growth over the next 6 quarters from what I'm reading. When you look at that, you want cash flowing companies, regardless of what the economic backdrop is, and you want them returning capital to you as an investor. So give us your 2 cents on that.
Look, at the end of the day, I was having a conversation just earlier this morning about getting invested into growth plays right now. And I am a fan of investors investing. And to me, what investing really looks like is the long term. And so if you are jumping into the market and you're thinking that you're going to, fare well because you're going to invest money, today, and then by next week or the next bounce or in 6 months pull out, I would say you may want to double down right on investment strategies and take a look really at these definitions of what you're doing. Are you really trading or are you really an investor? Now, if you're getting invested into growth plays, I would just start to look at what the next 2 years, 4 years, 10 years out may look like for these companies, because growth investing, and I think you touch upon this often as well, Colton, is it takes a fair amount of value to actually go into these growth companies as well. Now, as for me, I love sleeping at night. I don't like sweating throughout the day, and I sure as heck don't want to be checking my phone, hour by hour. What are my investments doing? So I like to get invested into value plays. Of course, these are dividend stocks for me, where I'm tossing my money into the market, and really from there, I don't need to look, because these companies that I'm investing into are stable. And I think when you really look into some of these bigger portfolios of, the Buffetts, the Mungers, Bill Ackmans, even, they're doing the same thing, right?
Yeah.
And I think it's just attractive to gamble money in this day trading mentality that a lot of us have. But I'm a fan of being safe, especially during market conditions right now. And I think it comes down to safety and value.
So you're making a great point. So here's the issue I have with growth investing, and I'm starting to see a lot of actually credible people on YouTube running growth valuations, and I run mine super conservative. And I don't get, usually a lot of growth investors probably don't like me running valuations on growth. But to give you an idea, the big problem I'm seeing, Ari, and you kind of touched on it, is the expectation that growth rate is going to sustain for the next 3 to 4 years. Well, obviously, we don't know what tomorrow is going to bring. How are you projecting 40, 50, 60? Some of these companies are projecting 100% compounded growth year over year for the next 3 years. And, I did a recent valuation on NIO. Now, this is a company that went up to $60 and down to 11. I did a valuation on it. I think it's an interesting buy at 13. It's sitting right around 20 right now. It's an interesting buy at 13. I think conservatively, that's a good buy. And I think it's a $30 stock in 2030. But with that being said, some people are putting a $50, $60 price target on this today, and it's trading at $20. And I don't know what's going to happen globally. I don't know what's going to prevent this company from growing. But what I do know is that we need food, water, and shelter every day. Your Kellogg's, your General Mills, your Coca-Colas. We need that on a daily basis. We don't need these EV cars in China on a daily basis when the crap hits the fan. So that's why the growth rates on some of these companies you really have to be careful, because the world can change overnight, and you want to make sure you own some exposure to companies we need regardless of what happens in the world.
I couldn't agree more, right? And I think, it's a testament to even Delta, missing on their earnings today. And as I was on my segment there in the news and sharing about Delta's earnings, one of the things that I touched upon was the fact that Delta's not going anywhere in 5 years. Yeah. They may have missed on their earnings, right? But they're not going anywhere. We have Pepsi just the other day that came in with their earnings. Another company that is not going anywhere. Now, that's not to say, what NIO may or may not be up to, where they may be in 2 years, 3 years, 5 years. I think they're going to be around. That's my personal take on NIO. But in terms of share price and their valuation, that's where now I, like you, would be more conservative.
Yeah, I would rather err on caution and realize that things do happen. I mean, I think we can look at this SPAC bubble that bursted, right? We were given so much stimulus throughout the SPAC bubble, and our behavior changed as consumers. We overconsumed during the SPAC bubble, and the SPACs cashed in on that. So what ended up happening was their growth rates were projected to be through the roof, because they assumed that we were going to keep consuming like this. And what happened? We had a tightening process, we have inflation, and now we're not consuming like that. And that's why you're seeing this SPAC bubble burst, because people put expectations on these companies to keep a 60, 70% revenue growth when the consumer is changing their behaviors.
You serious?
In SPAC news, Bill Ackman's SPAC just returned.
Saw that.
You saw it the other day, right? That happened just the other night.
Yeah.
Bill Ackman's SPAC will be returning the money back to shareholders. Right now, we're not in SPACs are very speculative plays, and right now I don't even think we are in a period in which you should be thinking about SPACs. A thing of the past. Where lives the blue lion? Somewhere in this amazing, beautiful world.
That's right. He's hiding out.
Right out of Tel Aviv, Israel, live. But look, to that end, I was taking a look, earlier this morning, and shocking news right out of the White House. And I think right now what's very scary is how much I think, the White House is trying to control the information that's being released, just because midterm elections are coming around. Colton and I were speaking the last live stream on the necessity to really begin to listen more to, you know, executives and business owners over the politicians. And I couldn't get that thought out of my head this morning as I was digesting, you know, what essentially the White House was coming out and saying was that, hey, look, you know, the inflationary report's going to come out, it's going to be higher, but everything is fine. I think, you know, as an investor, it's just scary, and you really got to start to make sense of who you're listening to. Again, to double down on this point, even those who are on YouTube, it's funny, I was taking a look at some other channels and noticed that some of the typical, you know, meme stock, hot stock type of promoters are now all of the sudden jumping on the value train. Yeah. And, you know, it's maybe one or two value stocks at the end of their videos, but just be careful right now in this environment, because you don't want to find yourself jumping in. Like I said, the market's bouncing right now. Investors are impatient.
I want to hit on that really quick, because I find this to be bull. All right. And I'm going to tell you, dude, I see exactly what you're talking about, because I follow some of these growth investors, because, you know, I want to see their thumbnails. I want to see what they're doing that I can learn from, because as entertainment, you know, YouTube is an entertainment platform. I want to know how to
let's not get out. Come on, you're looking at Voyager as well.
I mean, you know, Voyager could be a 10x stock at this point. We all agree on that. That's a no-brainer. Hey, that thing could go back to $1 and make us all wealthy. So no, I'm just joking. Do not buy Voyager. This is not a recommendation. But like, dude, the thing that is upsetting me is you're absolutely right. All of a sudden, I'm watching these guys, and all of a sudden now they're like, well, most of my money is in dividend portfolios and high-quality stocks. Really? I find that interesting all of a sudden, that most of your money is in these good quality companies when you've been pushing garbage for the last 3 years and gotten all your money and views from pushing garbage. But now you're telling people that you're not worried about this company going bankrupt because most of your money is in Apple, Google, Microsoft, and all the top quality companies that pay dividends. And how did that work out? Like, where was the transparency from the beginning? I don't know how people are not upset about that.
What sells is gambling. And that's what a lot of these YouTubers, you know, are throwing out in their thumbnails and their titles, and they're getting the views. But since I started my channel, I've been talking about one thing. It's been dividend investing. It's been value investing. I have not changed my strategy. Yeah. And here we are still to this day. I am still doubling down on high valued stocks for the long term. And it's very frustrating to see. Right? It takes a lot to, I guess, hold back, if you will, and not really comment on these videos like, hey, were you really investing in these companies 1 year ago? Because everybody's a genius in a bull market. But when stuff hits the fan like it is right now, and these market conditions are now very perplexing, right? For these YouTubers, these particular YouTubers, all of a sudden we get a bunch of value investors.
This is a great point, is that the people that are into the more speculation tend to kind of flock to YouTube to kind of watch it. When you think about the people that are investing in your Apple, your Microsofts, your Googles, are probably just DCAing, work a 9 to 5, maybe catch YouTube here and there. But it seems like the crowd of individuals that are on YouTube seeking out content are more the individuals that are searching for more high risk, high reward type environment. And so, not that there's anything with, listen, like I said, man, Scoreboard is the brokerage account. You do whatever works, and if it works, it works. So you can buy AMC all you want, and, you know, ride up Voyager. You know, if your account goes up, then you accomplish what you're trying to accomplish. So I can't knock that, but I think that's a great point.
Approaching 50 minutes now. Before we get going, it is my mother's birthday today, so she may be watching this. Yep, she may be watching this. I wanted to wish her a happy birthday and say that I love you, Mom.
That's awesome.
You know, you've raised a tremendous dividend value investor.
That's right. You raised a good man who's trying to change people's lives. And that's, you know, I think that's the purpose of what we're doing here. And, you know, obviously trying to come on here and whatever kind of knowledge we can give or insight, you know, not that we know everything, but we just try to communicate all together. And that's why the chat really helps out. But I think both of us have the mission of wanting to, you know, better off people's lives here.
Before we conclude for today, let's end on a solid note here with the stocks that we have in our sights.
Probably be, it's a good question. It would probably be, Let me, you go first. Let me answer this by looking at my watch list here.
So I did make a video on this, but I will, openly share. I already nibbled at Medtronic today. I'm going to be doing some more nibbling at Medtronic. Bank of America, certainly watching, but will be buying. T. Rowe Price is looking great to me right now. If Procter & Gamble, if the market really gets rattled and Procter & Gamble just falls, like plummets, I'm going to town on Procter & Gamble. Visa, I'd love to buy more shares of. Again, market really has to tank. And Apple, of course, Apple.
You always got to own Apple. So I'm going to go, mine's going to be a little bit different here. I'm going to pull it up and review it with you. All right. So want to own some different sectors here, Ari. So if we had a big pullback, I would probably be looking to own something like O or MPW. I'd want some exposure to real estate. I'd want a dividend. I want something safe. I would
get safer than Realty Income.
Yeah, Realty Income, or I like MPW. I think it's undervalued. I like MPW. Next would be the banks. I would probably go after maybe a JP Morgan, and I would layer that, believe it or not, with maybe a little bit of SoFi. I would obviously, so if I had like $5,000, I would probably put 4,000 into JP Morgan and maybe $1,000 into SoFi. And then I would be looking at the chip makers. So I like Micron on the dips, and I like Intel. So I'd have some chip exposure, some banks, some real estate, and then it would be Amazon, Apple, and probably Meta. Those would be the ones that I would want. I know I gave you more, but that's kind of how I would.
That's what you're looking at. That's what you have in sight.
So I don't see any questions flowing in here, man. So, we'll sign off here. Appreciate it, T, man. Thanks for the support.
Much love to you, T. Thank you.
And we'll see you next time, investors.